Okay, so today we're going to be diving into something that sounds boring, but I promise it's going to be super relevant if you care about taxes and if you care about giving back. Here's what we're going to cover today. We're going to talk through the difference between standard and itemized and how that plays into charity, how the One Big Beautiful Act changes the game, a couple different strategies like bunching donations, using donor advised funds, and the big one for the day, making non-cash donations. So under the One Big Beautiful Bill Act, the standard deduction got a pretty big increase. And so for most people, it no longer makes sense to itemize deductions. It's going to be $30,000 for married filing joint and $15,000 for single. The most interesting part of what happened was that the SALT cap was raised. Previously, there was a limit at $10,000, and now it's been raised. And that is a big deal if you're living in a high tax state, let's say New York, California, Massachusetts, New Jersey. And so when you combine the higher SALT cap with other deductible expenses like medical bills, mortgage interest, or charitable giving, you might actually be able to itemize again. And that opens the door to real tax savings. Now when we go into a couple actual strategies. So first of all, you got bunching donations. If you typically give $1,000 a year, it actually maybe makes more sense to give $3,000 this year and hold off the next 2 years to get you over the standard deduction limit. Another strategy is the donor advised funds. These let you make one large donation and then you can take your time giving the money to charities over the next several years. So it gives you flexibility and a tax break. And lastly, the non-cash donations. You're probably already doing this anyway. If you donate clothing, furniture, electronics, anything in value to a qualified charity, you can deduct the fair market value. So some considerations, once again, you're probably already doing this anyway. Anytime you donate old clothes to Goodwill, if you're going to be donating items whose fair market value is over 500, you do need to file IRS Form 8283 with your tax return. And if any individual item is worth over $5,000, you're going to need a formal appraisal. So think something like a rare painting or expensive equipment. So if we go into an example, Julia is a financial analyst in New York, which is a high tax state. So she's most likely going to be able to itemize deductions. And she starts thinking, hey, what can I donate? And she goes digging up in her closet and she finds that she has some old art supplies. She has an old laptop and an old antique desk. And she finds a 501c3 charity and she donates all of it. And they come out to be worth over $2,500. Now, since no individual item is worth $5,000, she doesn't need to get a formal appraisal. But since they are collectively worth over $500, she does need to file that special form with the IRS. Now, what that actually means for her is since she's already over the standard deduction of $15,000, this is only going to reduce her tax bill off something that was just collecting dust in her closets. If the value of the items is worth $2,500, we just multiply that by her tax rate of 24%, and she's going to save $600 extra in taxes. So some considerations, make sure that you're donating to a qualified 501c3 charity. Make sure you keep your receipts and sit down with your tax pro to plan around your deductions. If you are living in a high tax state, if you're already going to be over the standard deduction and you're charitably inclined, it might make sense to start planning to give to charity before the year's over. So as a conclusion, this is a powerful strategy for high W-2 earners, especially in high tax states. Always make sure to keep records and do it by the rules, just in case of an audit. And reach out to your CPA or tax pro. And if you have any questions or if you need someone to walk you through this, I'm taking on new clients. Thank you.